Welcome to It's No Secret, a podcast for Kiwis who want their money questions answered.
Ready, steady, go.
This podcast will answer the money questions you may or may not have on your mind. We'll talk to real Kiwis and share truths about our own financial lives.
Both the successes and the failures. Because the truth is, there is no secret to achieving financial freedom. Hello and welcome to It's No Secret. I'm Kat.
And I'm Christine.
And today on the show, we are chatting about index investing, passive investing. Christine doesn't know what this topic is. I just thought of it this morning on my way to work because I've been having lots of fun thoughts at the gym, as one does.
Yeah.
And I was thinking, or reflecting rather, on a conversation that Christine and I were having yesterday about when you are having a debate or conversation with someone and you're hitting them with facts and they're not getting on board with your point of view. This could be across anything. Doesn't have to be in relation to investments. You're just not getting through. And we were reflecting on that. And I'm like, well, how else do you get through? It's on their emotions. And it comes back to different ways of communication and why some people are like, emotional communicators, great storytellers, really get in your feels, get you on board. And there are
Hit you where it hurts.
Exactly. And then there are other people that are communicators that are more like functional, technical, really like rules-based or facts-based and kind of come in hot. And the chat we were having about this topic was not at all to do with investing. But then this morning I was reflecting on okay, how do we get people on board with passive investing as a concept? So many people still love active fund managers or direct stock picking, and yet we have so much great data that proves or shows why that's really challenging or why over a long period of time that is less likely to generate a successful outcome for you as an end investor, and yet they are just not really wanting to hear it.
Not rational.
No. And so then it made me think, and this is the topic of today's pod, convince me on index investing without telling me any facts.
What emotional about index investing?
Because then I was thinking to myself, okay, so why is it that I choose index-based investments for all my portfolio over anything else beyond just what I know about the numbers? And whilst Christine's thinking, I'll give you a little bit more time and do a bit more of an intro, or just to make sure that people understand what we're chatting on here. So with this, what I'm talking about specifically is investments, and we're talking obviously it could be share markets, could be bonds, could be whatever, but investments. So we're not comparing, index funds versus cryptocurrency or index funds versus investing in a business. We're talking about you've decided to, invest in an investment, a liquid investment, and you're opting for either an active manager or a direct share portfolio recommended by a broker or an index fund, or potentially how you invest your KiwiSaver. So that's the scope.
Okay. My brain initially went to so the things that I know about index investing is primarily data or fact based, and so I in a lot of ways might struggle to explain on an emotional basis why index investing, unless you went to what does that create for you? So bring it back to goals or ultimately you're trying to use this investment vehicle to get to the thing that you like, but that's more about investing generally. So then I went to, but why not active?
Yeah.
So if you flip it to be not why index investing, but not why not?
Yeah.
Do you know what I mean?
Why not active? Yeah. Why not NZ funds? Why not Milford?
Exactly.
Why not Fisher funds?
So then I went to, why also, to understand why not, you have to understand why. Why do people want to do active investing? Is it because they want to feel like someone has it's the control element or it's the emotions behind the potential upside. If you're trying to time the market, it's the opportunity there and that kind of thing.
Doing better than other people.
Exactly. But also I think because generally speaking, active managers charge a higher fee, they also provide more personalized services in terms of wealth managers and one-to-one relationships and stuff. And then I reflect on a conversation I had yesterday with someone who is trying to convince someone else on this idea, and they were saying that person basically was I like to see the shares going up and down, but I also just really trust the person that's like behind the thing. So like
more than they trust
the data. Yeah. Like it's like I value the relationship with that broker so much. So it's like the emotional connection with the person that's at that firm that's supposedly doing better for them. And that's the emotion of like, no, but let's unpick that a little bit because like
that person's not going to be nursing you in retirement.
Exactly. Do they really actually care about your financial outcomes, or do they care about making money for their family and for them all looking like a best performer in their whatever, despite the underlying performance being worse? And so like that's why I'm like, that's so irrational.
Yeah.
You know?
I know, but emotionally driven, which is where I've gotten to on this topic and conversation, because I also think that I was reflecting on the story that I think I've told before of having a client in Melbourne that we worked with that basically had a lump sum of money. They had $1.5 million and they decided to run their own experiment, and they invested $500,000 lots in 3 separate portfolios. So one of the portfolios was directly with Vanguard, because at the time, if you had over 500K, you could go straight to Vanguard, like straight to the fund manager. And it was in essentially their high growth fund. They then invested or gave $500,000 to a stockbroker that worked at one of the bigger firms to fully invest. And as you can imagine, that was like a full stockbroking experience where they, you know, had recommendations for buys and sells and all that kind of stuff, and like a relatively high turnover in the portfolio. And then the third portfolio was that they had a pure mix of active fund managers that we as their advisor helped them select, and all of them were very similar kind of asset class allocations, like global 100% shares basically. And they didn't contribute any more to each of those portfolios. It was like the lump sum and then kept that money invested for I think 6 years in total. And then at the 6-year mark, they basically had a review and were like, let's see who's done the best. And lo and behold, the index fund had done the best. But it was also their way to have a lived experience of what type of investment strategy do we really believe in, and how does this work in practicality, and therefore what are we going to do with our money kind of going forward. And I just felt like that's a really interesting one, because people don't necessarily have the resources to replicate that type of, you know, experiment or experience themselves. And so, you know, it's all well and good for, well, no, actually, then I was just thinking more personally. I'm like, at what point did I change from being the advisor to that client that recommended the active managers in a portfolio to all of a sudden being like, everything that is invested in the share markets is in 100% index funds, which it has been for quite a long time for me now, well pre-Kernel. And so I was just trying to reflect on that myself, to be like, what was it that got me across the line? And then what is it, to your point, that keeps me in that spot now and gives me no fear of missing out or desire to go to a different style of investment management or do something else, and are some of the driving forces and emotions that prompt people to pick a more active strategy being fulfilled in my life in a different way.
Like as satellites, do you mean?
Well, no. So I was like, okay, so maybe part of it is the fact that we've invested in a business. And so that is relatively high risk, high reward. Like that in my life ties in or drives into that emotion of like, how can I do better than everyone else? Which is, you know.
Well, it's also you kind of have a lot of influence over that because you work on the business, right?
Yeah, but it's one of those things of like, this is the thing that could catapult me. Because I think that
rather than the active.
Yes, because that's kind of what you touched on the start.
It's like gambling to a certain degree.
Well, it is. Like with shares, right? People taking punts on certain individual companies within Sharesies. Why are you doing that? It's because you want NVIDIA to
skyrocket,
exponentially increase, so that within 2 years you can catapult much faster than everybody else had. And that's an okay human nature. But is that enough to sustain like a long-term investment strategy?
Do you think it's the core belief? I mean, we've talked about this in a couple episodes ago around like my belief that in New Zealand you need to get ahead using property.
Yeah.
But do you think it's like also the understanding or knowledge around like I can't get ahead to the level, or that is not going to give me the potential upside if I do index investing versus these other things, because it's the like opportunity of growth.
Yeah.
And
is it bad when we say you get just the market average because no one wants to be average?
Exactly. We're trying to match it, not outperform, basically.
And we all love to think that we're going to be in the 2% that outperform, not in the 98% that underperform.
Yes.
And we don't think about all the other funds or crazy fund managers and strategies that have failed over the past and no longer exist. We just like to focus on the potential positive, like the potential that we're going to win the 50 million.
Yes, but I was literally just thinking about this phrase that says like there's a lot of debate around parents that tell their kids certain phrases and then how they then perceive things like over time, right? So if you tell
Do you
your
want me
kid,
to test this in real time?
yeah, sure.
Okay.
If you tell, I mean, Gary Vee, it's controversial. A lot of people don't like him, but he always talks about how he will never tell his kids that they can be whatever they want to be.
Because they can't.
Exactly.
I'm so on board
but
with this.
he doesn't let them win races. He always like isn't trying to like obviously knock their confidence down to the point where they have none, but it's more about like showing them the reality of life basically. But I think this extends to like that point of everyone kind of thinks, do we like you have to be in the 1% or like strive some more when really like it's actually okay, and you are going to be okay if you're average.
If you're in the average.
Yeah. Like,
in fact, you'll probably be a lot better than the people that are striving for more than average, because the thing that comes with striving for more than average is the high chance of failure in multiple numbers of years.
Exactly.
Oh, yeah, complicated emotional challenges. So
I feel like I had another thought, damn it.
Well, my other thought on this, because I was obviously then like, okay, when did I switch? Because I grew up in a financial advice world where like I wasn't even aware of index investing and Vanguard in Australia until the fourth firm that I ever worked at. And so a good like 6 years into my career kind of thing. And I was like, what made me actually, no, that's a lie, because I was aware of Vanguard when I was working at this firm where the client conducted their own experiment. But at that time, I wasn't yet investing personally in index funds. And then I went to see our advisor that we saw, and I went in hot and was like, I don't want any active management recommendations for my Australian super and my investments. I want a 100% Vanguard diversified fund suited to my risk profile. And since then, we've never varied the path.
Do you think it's the lived experience? Because by that person that you advised doing that test, your lived experience was also seeing like how this test performed basically. And then once you try it out, it's like we often talk about the aha moment of like at what point is gonna be the thing that forces you to either start saving, start investing, or change your behavior. And oftentimes with investing, it can be you seeing the growth of your investment. Like when that's what it was for me, to be like, oh my goodness, my money can work while I'm sleeping. That's the thing. But could that be the thing between, for you seeing that growth versus...
And also you saying that has just reminded me it's probably all the reviews that I sat in where you basically have to come in and essentially defend why a certain active manager that you've recommended in a portfolio hasn't performed or has underperformed or has been in a time, and you're constantly having conversations around performance in a defensive way, predominantly defensive way. Like, sure, if you have a full active manager portfolio, there will be maybe one or two funds that for the period that you're looking at have done well, but there's also a lot that haven't. And at the time, I didn't know any of the data to explain that to people. And so, of course, you're inadvertently having lots of conversations where you're essentially justifying to people why it's great to like stick the course and, like long term and
it's all about the relationship building.
Exactly. And all that kind of thing. And then I got to this point of probably thinking like, I am an independent financial advisor. Like I don't owe anything to those managers. And ultimately I have a choice. And then I think the other thing for me was really firm of you know, they often say if you do work with an advisor, like ask that person how they invest their own money. And then, of course, it became very clear to me that that's my choice. I just want to opt for like the passive fund option.
Yeah.
And that is how we have opted. And then like Luke kind of followed suit, and how our Australian super remains invested, how, of course, our KiwiSaver is invested here, and our other investments outside of course, like our business investment.
Yeah.
But that I've just never varied the course. And to your point of then about relaxing is I was also reflecting on this morning at the gym. I'm like, how little I think about my investments.
Like versus how often you used to think about them, or just generally?
Just in general.
Yeah,
just in general. And maybe that's also part of my personality. But as an example, like I know Luke never logs into his account ever. He's never looked at it. I look at it for him.
Yeah.
But then also I just don't feel the need to track it. I feel this really ingrained sense of comfort that the choice that I have made is going to get me the market average, and I'm happy with that, and I believe in the idea of capitalism and that the share markets are going to increase in value, and I've bought into the idea that I need to understand my goal and my risk profile and choose a fund appropriately, and then that gives me the power to just like sleep on my investments, which is a crappy message to tell people because it's not exciting.
Well, but I think there's also like a balance between being engaged with like your, you know, the KiwiSaver fund you're in based on the like life, whether you're buying a house, blah, 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 like being engaged with your investments versus being too engaged.
Yeah.
Do you know what I mean?
Yeah,
like,
I do.
Yeah.
I do.
Yeah.
But I just think of like, what? Yeah, I don't know how I would spend more time.
Well,
what
are you going to change
Maybe
if you've got the like strategy down and you, I mean, you probably know a lot more than the average person. So you probably have a lot more confidence in that, like, I've made the right decision. I don't need to have it validated, you know, but also I think that to me is the value of a financial advisor, not the asset allocation. It's the accountability, the validation of the choices, the like regular check-ins, that kind of thing. But once you can do that in like a fee for service way, you know, and then have that along the way without having to, and then you don't have to be so engaged because you've got that professional doing that for you.
Do you think that people assume exactly what you said with active management then? Because then it, like, I would love to hear from, I would love to hear from some people on the pod to like poke holes in my argument of, are you also out there investing with an active manager, sleeping well at night and not like checking in on the markets or even looking at your investments? Because are you leaning into that notion that they're experts and they can deliver and they're working hard on your behalf? Is that what is giving you comfort? Like, what is the thing about the other investment choice that is really connecting with you on an emotional level? Because if we were to sit here and debate various investment methods from a data point of view, I think what we would find is the vast majority of people don't make investment decisions aligned with data.
Yeah.
So what is it that's connecting with you beyond the numbers that's making you decide to go down a certain path?
Do you think?
Open call out to listeners. Slide into the DMs. I genuinely want to debate and discuss.
Yeah. I also want to know if the thing that is like, if that thing is basically because someone else told you to, or because you're potentially trying to carry on a decision that was historically made by someone that's important to you. So for example, like an inheritance, if that person decided, the person that made all the money and that's passing that on, and this is what they core belief, like it's the same with like property, 100%. Right? Of like, I really believe that this asset class is the thing that's going to propel you forward, or it's this style of investment. So this is the conditions around how you then manage it. Or if you want to honor that legacy of like, oh, but they chose this fund manager, so I'm going to stay with them. Or they had this particular like relationship, so that person's great, I'm going to carry that forward.
Love this. This
would
is
love
so,
to understand the
true.
Rationale.
As you were saying that, I was thinking about if I'm ever lucky enough to inherit some of mum and dad's share portfolio, I am going to get so much joy from selling those fuckers.
Same here.
Those 5 direct shareholdings that they have been holding on to for far too many years. I'm going to be like, bye.
Yeah. Same with me for my mum's like beach house. I'll be like, first thing that goes.
Just goes. So yeah. But it was just, I thought it was a really interesting one because I think like there's a lot of complexity to how we pick investments beyond just understanding. And there's a lot of education and a lot of amazing podcasts out there that talk about, obviously, and, you know, us included, we've talked a lot about making sure you understand things and finding the right level of information and focusing on your goals and really getting across different asset classes and looking at fees and looking at like performance. But it also is important to understand that for some people or for everybody at some point in time, like there's more at play than just those things as well. And so how do we recognize and then tap into making sure that other parts of our personality are fulfilled with our investment choices beyond just the rational thinking. And I think to your point of like, that really is why I loved being a financial advisor and why I loved working with a financial advisor, because that's what that person provided.
Oh, like the person doing all the things. Yeah. That's like you get to live through them in some ways.
Yeah. Or even exactly. But also even when I had decided using a financial advisor and had decided we're going to have 100% passive strategy, I was kind of like, okay, well, great. Now that time that we otherwise would have spent in our meetings discussing like active management strategy, we get back to talk about other things because my approach was just like, sweet, that investment's kind of ticked off. Nothing's changed in our goals. Therefore, nothing's changing in our asset allocation. Cool. 2 minutes review done. Let's talk about all the other more exciting stuff that really like fuels me and lights me up, that in my mind is much more active investing. Like, how can I think about starting a business or be investing in another business or whatever that piece is for me. Whereas I can imagine for some people, the choice and relationship and ongoing management of a share portfolio or a more active management portfolio is also then the thing that lights them up.
Yeah. But I mean, do you need to do that with your life savings? Like, can we maybe just have some satellites instead?
Well, therein lies the challenge, right? It's, you know, how do you get people on different wavelengths to understand not only the data behind it, but then also the potential like emotional or life impact of the choice.
Yeah. Yeah. I'm just thinking about like applying that logic to every, like how do you apply that to different asset classes? And I think that private equity is a very good point. I also probably get it through that. And I need that a lot more than Ollie does as well. So maybe
like
understanding.
The excitement. Yeah. Kind of like, opportunity for future freedom or flexibility or an opportunity that I otherwise wouldn't get.
Yeah. And I think in my head, because my appetite for risk is much higher than Ollie's, I'm like, we need to take risk. We've got to like, we're young. We've got a long time to recover if it goes pear-shaped. Like,
this is Luke and I with renovating houses.
Right.
The same kind of thing, right? It's like that for us is the thing of like, here's our opportunity to like get ahead or do something. Yeah. Yes, add value, do something different to someone else. Yeah. This is our opportunity to like find a bargain and do something that we can contribute to. And I'm actually just quite glad that that's the path in which we've chosen, as opposed to
gambling
or share markets where it's like, because I try and apply the same level of, well, our life would look different if we were applying that same level of logic to, say, our investment portfolio.
Yeah.
You know, it would have a different structure. But for us, that's not the thing. And actually, it's a case of we're being fulfilled in another area of our lives in that way. Yeah. And actually our retirement savings and long-term future is kind of
slow and steady.
Yeah, slow and steady, boring AF.
Yeah, I love that. Love this. Well, I'm here for more rogue episodes like this. Great thoughts.
Yeah, just great random thoughts. I actually really want to hear from people on the show, listeners, because I think it's just a really fascinating not to like, don't want to get into a debate of what's a better strategy, because I think it's horses for courses. We've talked about that before.
But I'm like, no, I think we can.
Okay, well, maybe slide into the DMs and I'll read them first and decide whether or not I'll let Christine debate you.
Will I just send back data? Maybe.
Yeah. But we would love to get into the psyche of what is driving your investment choices, what's really connecting with you in terms of choosing a particular type of strategy or fund manager or KiwiSaver provider, and how have you come to be really happy with that choice?
Yeah. Nice.
Let us know.
Love it. At It's No Secret NZ on Instagram.
Yeah, because I'm here for index funds all day, every day. Literally, my whole life. Never plan to change. Not going to own a share if I can avoid it.
Just in a fund, in an index fund.
If Kernel ever lists on the stock exchange, I'll be forced to sell. Eat my words.
See ya.
But Welcome to Cat's Mind.
Yeah. Stay tuned for a lot more. Until then, we'll see you guys next week.
See ya.
Bye. Bye.